Hello everyone, welcome. This screen looks a little bit crowded, but you have to bear with me. We're going to go through the rate sensitivity complex, go through the whole list of names and see what's the general dynamic right there, because this is the main thing right now, the main dynamics that identify the behavior of the fiat alternatives, asset classes, the precious metals, gold, silver, platinum, etc. Currencies, impact currencies, very much so, credit, and equities to some degree, and obviously the fixed income asset class itself. This episode is going to be a little bit unstructured, but we're going to cover a lot of things, so it may not be as brief as the last couple of episodes. Well, first of all, what are we doing here? We are utilizing our signal, the proprietary signal that we created, the volatility adjusted signaling process that incorporates flows, incorporates volatility, incorporates volume, incorporates option dynamics, market structure. The proprietary thing that the most valuable thing that we have created and we utilize on a daily basis. Essentially, it gives us the identifies the trend. It gives us understanding of the trend, understanding of the current flows, understanding what direction we want to be positioned in any given instrument, and understand the probability of the move, the relative probability. It's all backtested across different asset classes and fine-tuned to the different asset classes and different instruments based on their volatility characteristics. And that's what we are doing. In these episodes, we are putting that signal through the whole list of asset classes, and by doing that, by looking at everything at the same time, understanding the correlation in between the major instruments, understanding the dynamics, how macro works, the dependencies, we can arrive to the basic understanding of what the market right now is pricing in and the probability of the major move. And by doing that, we increase the probability of being right. So one thing points in one direction, and the other thing that is 90% correlated with that thing points in the same direction. You just amplify the probability of being correct at guessing the upcoming move, at guessing the upcoming direction. When four things in the rate sensitivity complex are pointing to the same thing, that you are increase your probabilities of being on the right side of the market even more, and so on and so forth. And we do that with everything. So the rate sensitivity complex, what does it incorporate? Rates themselves, rates across different countries, across different maturities, obviously, credit market, fiat alternatives, currency market itself, and sectors, some of the sectors, and equity, some form of equity, the most sensitive parts of equity. So a lot of things to cover. On these four screens, we can see the currency, we can see the dollar, the main guy from the currency complex, which is pointing to the expansion into the upside, signaling bullish, a positive trend after the break of this key level, and signaling positive trade momentum. At the same time, this shows us that the probability of creating a high low within those boundaries is increasingly high, and we might see another move in the dollar higher. Yes, we are at the top end of the risk range right now. It's not the time when you want to be leaning long gold aggressively. This is the time you want to be more interactional, more neutral, and as we can see, all of the names right now in the middle of the ranges, all of the instruments that we are looking at in the middle of their ranges, respective ranges. That's why we think this week upcoming week is going to be very neutral. Maybe we're going to see a retracement in this overall overarching trend in the repricing of rates higher, but nothing major is going to happen before that. We're still leaning long gold, leaning long dollar. But we're acknowledging that we might see a retracement in that move. On the news front, nothing major on the news front, but except the Yellen speaks on Wednesday. Let's see what she says. and minutes. We get minutes on Friday, if I'm not mistaken. Other than that, rather sanguine week, rather quiet week, and we can see that, we can observe that in the vol surface, looking at the 0 DT options vol surface across the curve. No volatility, everything is honky-dory, and we haven't yet crossed the X date. By the words of the Yellen, the X date is gonna be 1st of July, but I'm talking about right now about the debt ceiling. But by the looks of it, by the rate at which the Treasury General Account is drawing down the reserves, they will still have money up until 15th of July. So the X day may be a little bit shifted forward into the future a little bit. So this gives us even more time of maybe no volatility, maybe quietness, just simple, quiet peace. That'd be nice. The dollar pointing to the upside, still pointing to the upside, but at the top end of the risk range. So be careful with the long positioning right now. Gold, a broken trend. We shall see. Gold is the strongest one of the whole rate sensitivity complex, but it has broken trade. Right now it's testing its trend. Let's see, by the middle of the week, we're going to see and we're going to understand whether gold wants to hold its trend support or it wants to break its trend support. I think it breaks it because, well, everything else in the complex is pointing to the gold breaking this level, so why wouldn't it? Why wouldn't it? The one reason why it might be holding so good is the fears in the market regarding the debt ceiling debate, and if they announce technical default, they will be late on their resolution. Maybe gold will perform quite well as it's supposed to do in that environment, but we shall see. We shall see. Right now, it's pointing to the downside definitely, and what we did on Friday, actually, we sold a skewed strangle. The implied volatility is still relatively elevated, and we just sold a skewed strangle. Skewed strangle on GLD. GLD, let me pull that up. Meaning we sold 180 put, 185, yes, 185 put somewhere on here, with the break even of 190, and the 175. We sold 180 call and 175 put. So the break even is pretty wide. We expect this week we expect maybe a retracement, but more of a consolidation. If we with the position that we have with the skewed strangle, we have continues falling downward. We are totally okay with that. Credit component of the rate sensitivity is also pointing to the downside. Clearly, we broken trend and broken trade. If we are in the middle of the range, at the low end of the range, to be more exact, but we think we are going at 100 and around 105. I'm going to be retesting 105 in the nearest future. Same thing with the utility sector, the most sensitive sector out of all 11 sectors in the US. The guy has been holding pretty steadily and pretty nice. We actually contemplated the thoughts of going long utilities, but when it became clear to us that the rate sector is going to reprice higher, these guys, we announced that they're going to get pounded maybe 2 weeks ago, and this is essentially what happened. So the same thing is happening here. It continues to support that idea of repricing of rates higher, and even a small rebound into this area is still simply pointing to the creation of a lower high. Where we might be wrong. Can this guy just create a higher low continuation here and go higher? Can this guy create a higher low continuation, consolidation and shift higher? Absolutely. Can gold do the same thing? Consolidation and shift higher. Can dollar consolidate here and break lower? Absolutely. That can happen. But for that to happen, we have to go through that period of this consolidation. That's why we are so relatively indirectional on all of those names. If we're going to stay in consolidation within those areas and create a structure that allows us to break into the downside, if we're going to do the same here, and here, then we're going to be prepared for that, because we are in that market where we are in a heightened period of uncertainty. So no major lasting trends. We have to be ready. for the market to just reverse on ourselves. So we are prepared for that. We are watching on a daily basis. Let's see what the market brings us. That's why we are selling straddles, puts and calls being relatively neutral on the whole complex, on the whole market. The one thing to point out is high yield as well from the credit sector. Bearish trend and bearish trade at the same time. If this move in dollar persists, if this move persists in rates higher, high yield is going to be under some pressure, definitely. It still signifies a bearish trend, a bearish trade, so that's the reality of it. Let's just get rid of all of that stuff and leave one chart in place. Yes. The other thing we need to look at is what is it? Oh yeah, the rates themselves. The rates themselves. What's going on? What's going on there? What's going on with the 2-year, 30-year, and 10-year? We've seen this jump in rates higher. They are across the curve. 2s, 3-year, 10s, and 30s signaling bullish trend and bullish trade, the potential creation of a higher low right here, and continuation, maybe another leg of repricing higher. So we are preparing for that. We're set up for that. Well, once again, we acknowledge that we might get a retracement, or at least some sort of consolidation in that move, which will be well within the boundaries. Just look at the numbers, not to see underneath that watchdog. Yes, the probabilities. We are somewhere around 40%, if I'm not mistaken. Probability as of. Wait a second. What's that? It's a 1406. That yeah, that's the correct date. Yeah. You sure about that? 82% of staying in the same range and only 17% of repricing higher. That's a strange reality. I'm pretty sure the day before yesterday I saw 40% right here. Okay, even if it's 40%, even if it's maybe some mistake, if it's not a mistake, it still has some ways of repricing higher. Why? And what will it be dependent on? Right now, let's step back a little bit. We have two major dynamics that define the direction of interest rates right now. Is the Federal Reserve policy, which we think we are getting right in this moment of time. We are expecting repricing of rates higher just based on. They haven't announced that they're going to cut rates. Definitely, they haven't announced that they said they're just considering stopping, but the inflation data, the underlying inflation data is coming in very hot. The underlying employment data is coming in very hot. So these are the two metrics, the major metrics which everybody is acquainted with, and these are two metrics that identify the direction. The upcoming unemployment report the week after the next one is going to be very important, and the inflation report as well. And only after that do we get the Fed meeting. So those two variables will identify and will shift those probabilities meaningfully, and only then we will see a major volatility in rates themselves by the nature of repricing of rates high, because those numbers will impact the market view of what they're going to do. All right, that's understandable. We still have 1 week before that, so we are positioned. That's why we think this week is going to be relatively calm on the rate complex. Another variable is the debt ceiling. If it's not going to get resolved, I hear people talking about that. If it's not going to get resolved and pushed, they announce technical default, yields will absolutely tank, and we're going to get a major risk-off event. This might happen, because they are bringing up the idea of the 2008 in comparison back to 2011. I'm sorry, and that's essentially what happened in 2011. But one thing to point out, one major thing actually to point out. Let's bring back the 2011. This is our 2011, and this is our debt crisis right here. The ceiling crisis right there. And let's overlay it with the US 10-year. We had our resolution. I don't remember the date exactly, but we had our resolution even before that drop. We had our resolution already. It was somewhere right here, if I'm not mistaken. Well, it's largely irrelevant. The point I'm making here, that our signal across the whole rate sensitivity complex and the equity complex as well, has been pointing for 2 weeks before that happened, before the whole debacle with the debt ceiling event, has been pointing to the downside, has been pointing to the bearish trend and negative trade within the SPY itself, SPX itself, and within the 10-year yield as well. So we've gotten this move to the downside, and we got this move in the equity lower. Right now, the situation is polar opposite, completely opposite. Rates are pointing higher across. The whole complex is pointing higher, and the equities are pointing higher as well. Across the whole complex of equities, everything is pointing higher on an immediate basis. Some of the names are pointing higher even on a trending basis, meaning a quarter ahead, and some pointing higher on an immediate basis. So if we are going to get something terrible happen, I don't see us getting this type of a move. Maybe another non-trending spike in volatility like we had with the banks. Maybe that is what's going to happen. Maybe we get a 3 days of SPX downward movement. We get a 5% drop in SPX. Maybe that. But right now, the overall trending situation and trading situation everything is pointing that the polar opposite is going to happen. And the other thing, the people I very respect say that if they're going to push out and announce technical default, yields this time are going to spike higher rather than lower. So the signal, we are not the macro geniuses. We just going to remain and stick with the signal, and that's what we have right now. So back to 2-year yield. Same thing here. High low. This is the place to get long of the 2-year yield, and we may be in consolidation, may be in retracement. Everything that happens within those boundaries are absolutely acceptable from our signaling point of view, and we expect another bounce, another move higher in 2-year yields, in 10-year yield as well, in 30-year yield as well. So that's the general situation. In Europe, the same thing. In Europe, in 10-year yield are clearly signaling expansion to the upside. This is a very strong signal, a trending high-low on a trending basis. I apologize. And we are going into the 2.55 in Europe. The long end and the short end is doing the same thing as well. So another repricing of rates higher. And in Europe, they are incredibly adamant in their view that they're going to keep raising rates, and they will quell inflation. And we are in that battle. Where I watched the Russell Napier interview and presentation yesterday, and he said that the key metric to look at is the debt cost of debt service overall in the economy, cost of debt service in relation to the aggregate private income. And if it's above 20%, this ratio is above 20%, you're going to get problems. If you raise rates very fast, you're going to get problems. And in France, in US, in China, these 3 major countries, all of these ratios are around 20%. And we've just raised rates in the most steepest manner and the fastest that we've seen in history. That's the prelude to that chart, to the to the Haggai infographic. This amount of raise caused the 1990 recession, dot-com bubble, financial crisis, 2018 slowdown, and this is not going to cause anything. Maybe it's not going to cause anything. I'm trying to piece together the secular trends with cyclical trends, and these secular trends are clearly impacting the cyclical's reality. So the business cycle is not going to look the same as in 2020, 2008, 2002. We're probably not going to get this sharp breakdown of credit and sharp move down. No, because the governments won't allow that. But we have to get something. We have to get some move into the negative territory. And by the looks of this business cycle, we're still doing totally fine. We are going into the deepest part of the recession in the second half of this year, that's for sure. But before that, we're still in this slowdown period, but the equity is still, the equity market remains relatively, the big names in the equity markets remain relatively indifferent to that reality. But yields are pointing higher right now, and we have to get some problems in order for us to whether get to the financial repression that the Russell Napier is talking about, get to the yield curve control, or bring down the economy enough in order to destroy the inflation completely, bring it down back below 2%, remove the structural shift in the wage growth in the economy, bring inflation really down. But the only way to do that is to create a really severe recession, and in order to get a sustainable kick of the can down the road. So the two realities right now. But right now we are sort of in no man's land, in a la la land right now. Equities is hovering and doing pretty well, so that's the reality. And the rate complex, it's like reflation once again. We are repricing higher. We're repricing, going higher, and let's see how it's going to turn out for Europe. The major raises in interest rates plus the 40 billion in QT, if I'm not mistaken. They're doing around 40 billion, and then they thought about accelerating QT. It's not good. It's not good. Theoretically, it's not good, but the stock market in Europe, DAX, has just printed an all-time high, so that's relatively all right. Okay, so these are the realities. The rate complex pointing to the same thing we've been talking about since for more than a month around that period. Repricing of rates higher. Another interesting thing to point out, just a fun fact. These are bunds, not bunds, JGBs. Not JGBs. Oh my god, I'm losing myself. UK government bonds. I forgot the name. I forgot the colloquial name they use for UK bonds. Man, I got to remember the name. Okay, so this has caused a big problem within the pension funds in the UK. This sharp rise in interest rates. Yes, the problem is in the severity and the velocity of this move. Yes, but look at that. We are almost at the same exact level, and I'm pretty sure the yields are going even higher than 4.7 in the UK. So, the rate of change of the move, meaning the velocity, is very much of importance, but the level is of importance as well. If it stays at that level for a prolonged period of time, it is going to have the same impact as this move on high velocity to this level caused an panic, basically, within the UK central bank, and they forced to reverse the QT policy. That's what caused the pound to drop almost below parity with the dollar. So we are within that horizon, within that level that caused the panic, and we are going to stay here, and we are going probably even higher than that. And the level, once again, is relevant if it's persistent. It's relevant if it's persistent. It is going to be persistent by the looks of it. So these are the realities. Not good. That's not good. Not good. Yes, this as to the rate sensitivity complex. The timing matters. The timings matters incredibly. Let's see what happens there. With the dollar, once again, same thing with the dollar, same thing with the euro, same thing with across the whole currencies. USD JPY, the people continue they continue to do the yield curve control. They maintain the yield curve control policy, and it has a very negative effect on the USD JPY, and it's essentially the mirror image of the rates in the US. Rates repricing higher, JPY losing its value against the dollar, which is buy. But the reality that they constantly provide liquidity into the markets and buying the endless amount of the bonds. This is the what effect it has. This is the effect it has on the stock market. Where is it? The Nikkei. In Japanese terms, obviously, a major move to the upside. And if we plot the UGJPY on top of it. Look at this. The correlation is, well, spot on. Correlation is spot on. This is on a trading basis. Same thing. The correlation is spot on. And as we expect this move in the dollar to persist, expect this move to the rates to persist, expect this move therefore in JPY to persist, expect this move therefore in Nikkei to persist as well. If you want to play that somehow, that's the DXJ. The best way to play that is GAJ. That's if you want to trade that in US dollars. EWJ, DXJ. These are the ETFs. Okay, let's stop with that. The currency and the rate sensitivity complex is, we've gone through that. We understand what's happening there. Gold, silver, once again, we can get a retracement. Well, like the orange bars is the key trending levels, weekly levels, and everything else in between. We are looking how price interacts within them. We are at the low end. We might get a bounce. In silver, we might get a bounce in gold as well, but we are, as of now, we are the sellers of that bounce. Crypto has been moving in lockstep with gold. Let's put the gold up right here. Let's put the SPY right here as well. So the general moves in those names, major high lows and the lower highs on the trending basis are the same. If we're gonna get another bounce, gold higher meaningfully, or SPY doesn't belong here. But if we get a repricing of rates higher due to whatever happens, and repricing gold higher, we expect repricing of Bitcoin higher as well. On its own, the signal says and points out to the upside. This is simply another retracement within the bullish trend. Usually after the third leg right here, after the third leg in any instrument that you get, we've been calling for this high low on the trending basis, and it happened vigorously, very fast. We didn't spend much time there, but this time it takes a consolidation. It's still signaling a bullish trend. We're still holding crypto right now. We're still not crypto, not the whole complex. Bitcoin, Ethereum is still weaker than Bitcoin, so Bitcoin is the best part of the whole crypto complex. It implies consolidation. Everything that happens here is within the boundaries, is within the normal boundaries, within the normal deviation on our signal, and we can expect, if we get another move for lower in Bitcoin, that's another just buying opportunity. If we get a consolidation with run and structure creation of a weekly high low right here, we expect another repricing of Bitcoin high. Just looking fractally and comparing this cycle with the previous cycle, just by time itself, looking at time, we've already created this major flush to the downside. This was the credits event for the crypto FTX. I think if nothing really bad happens in that crypto universe, we have already printed the major tail high low for this cycle, meaning we're never going to retest this low, and we are somewhere around this area. This is what awaits us, this prolonged, very boring consolidation. It's the reality, and we may stay here for the next 9 months, 8 months. It's perfectly possible. I think from 6 to 9 months, it's a good call. And this is your area. It can do whatever it wants right here. If you are a long-term investor, this is a good place to buy. The only difference with this cycle compared to what we are currently experiencing is that we're probably not going to get this move, because this was an outlier event, 2020, when everything went down. We might not see something like that. If we're gonna get something like that, if we're gonna get some credit event in the US, if we're gonna get another war, maybe Taiwan and China, maybe Iran and Saudi Arabia, Israel, anything outside of the system, a major serious event, yes, we might get this move. But right now, it doesn't look like it's on the cards. It doesn't look like it's on the table, so we might not get this move, and we've been calling for the long of crypto during that time period. We've been longer for Bitcoin since If you remember our post about our trend signal, we've been long Bitcoin since that move, since that point in time. We did not expect this one. Well, by obviously doing our cross asset class analysis, we've been prepared for that, yes, and we exited right here. But if nothing happens, we might see just a simple continuous consolidation, and without that move, we'll just slowly will trend higher from that point on. One thing to point out, what are the risks associated with it? It's the continuous regulation, the upcoming regulation into that space, and introduction of CBDCs, and the probable ban in the US and Europe. This might be still on the cards. I mean, this might sound like a stupid thing to say, but this might be the reality. The most probable outcome is the taxation. You're gonna get taxed on your capital gains on Bitcoin, and this will be monitored very much. They're gonna monitor very what's the word? I'm losing myself. Scrupulously? No. You get the idea. They're gonna monitor and tax. They may tax upwards of 70, 75, 80%. Put a tax on the capital gain on Bitcoin. This is the reality, very much so. Let's say what happens with Binance. They may ban Binance in developed world. These are the realities. These are the risks you have to contend with. And another risk, not the risk, just the reality, is that we're not going to get the similar impulse that we got right here in the percentage terms. We might get back to 100, 120, but this was the move of a 700%. This was the move of 3,000%. From here, we might see maybe 1,000% increase, and maybe if you will be able to enter around those areas, you theoretically, if everything goes as this history shows in this instrument, and we're gonna get another expansion due to the halving event, you're not gonna get 700% increase from here. The cycles are becoming more and more muted. This is just the reality, and realized volatility falling more and more with every single cycle. So I would not be expecting a $10 million on the or million, even I would not be expecting even $150,000 to be honest. 200,000, that's a definite stretch. But you want to be invested. You definitely want to be invested. If you like, check out the post that we did in Liquidus. We put the signal we just applied the trend following signal onto the price of Bitcoin. It showed an incredible result. And if you are afraid of volatility, if you're not willing to hold through these 80, 50, even 50% drawdowns, this signal, this strategy, it reduces the downside volatility significantly while amplifying your returns. So this is essentially what we use for the Bitcoin right now. This is essentially what we utilizing ourselves. So I would proudly recommend it. Yes, this is it. This is the post. Since that period, I forgot the date, and no dates right here. We've got now long crypto signal on a trending basis. We're still holding our longs. How we look at it, we utilize 294 days realized volatility in order to determine our allocation to any asset class, and that meaning that we have 5% right now in crypto. If we want to add to Ethereum, we're probably going to add another 4% into Ethereum, 4 or 5% into Ethereum. So we are perfectly comfortable with holding 10% allocation to the crypto world, because that signal historically allows us to mitigate those moves, to mitigate these cyclical downswings, major downswings, really. Plus, monitoring these things on a daily basis, it allows us to, incorporating this cross asset class analysis, we are definitely can spot these moves to the downside. I hope we're going to be able to do that continuously. So let's see what the future brings. We don't know anything about the future, but we are prepared as we can be. This is the Bitcoin. This is the crypto market. Same thing goes for Ethereum. Essentially, the correlation between them are incredible. We've gone through currencies. We've gone through crypto. One last note. is that the altcoin complex, the alts are not doing very well, particularly well, and I would not expect them to do very well, to be honest. So I'd be holding only, we're concentrating only our efforts on Bitcoin and Ethereum. So that will be our future allocation. That is our allocation and will be our future allocation. But to sum this up, the whole rate complex signaling consolidation, the whole fiat alternatives complex with gold, silver signaling consolidation, and cryptocurrencies and Bitcoin signaling consolidation. This is a very, very hard environment to be in. We don't have this meaningful, lasting signal. We're waiting for this, but the consolidation, you have to play your cards correctly. Do not expect major moves. Yes. Briefly, and let me touch briefly on commodities. Oil is still signaling bearish trend. We do expect oil to continue marching lower and retest 66 again. We do expect another move lower in the copper prices, and across the commodity complex, there is no trend. The oil price encompasses and sums it up perfectly. This is not trend. If you are oil trader, if you commodity trader, you can play this. But we will put our longs or shorts in commodities when we get a clear, lasting signal. We don't get that. Everything in commodity space is pointing to the demand destruction. Every single thing, except the ag complex. The signals there are very dispersed. So some things may be pointing to positive trends, something to the negative trends. So it's not the reality where you want to be aggressively long the commodity complex and ag complex as well. So no. Okay, we've gone through that. We've gone through this. Fixed income, the equity. The only thing that's left is equity. Equity, credit complex, right? Complex. Once again, if the move in rates do persist, we expecting creation a lower high right here. But this is not the similar moves that we've seen right here, or major repricing of rates higher, which caused a major repricing in credit lower. This is just consolidation, once again, consolidation with negative slope. And this is not the signal to be, right now, to be cautious of that we're going to get some sort of the meaningful risk on event. So you can prepare. You might want to sell this lower high right here, expecting a major downward repricing, only if something happens with that debt ceiling. So this is pointing that be long rates and stay cautiously long of the equities right now, because the credits environment are pointing to the downside right now. High yield EM, emerging markets, same thing. LQD, investment grade, same thing. BKLN, senior loan ETF, same thing, consolidation. We think we'll continue to be in that consolidation. Mortgage. The things are very sensitive to repricing of rates higher. Same thing, bearish trend. We might create a lower high right here. Mortgage rates are staying, rightly so, just staying in consolidation. This is our call generally, so nothing to see here. But they are pointing to our best case scenario anyway. And onto the interesting stuff. Let's go through the world first, and then we'll jump to the American equities. Europe, bullish trend, bullish trade. Don't ask me why. Everybody I listen to on the macro front and on the fundamental front saying that not good. The situation looking not good. We are in quad 4. We are in slowdown, possibly going into the contraction. It's not the reality right now. We are not long of European equities at this point. We are not long of the US equity, but we are cautiously short volatility. So that's what we do essentially. But the Europe, looking at the equity complex, pointing to the bullish trend, bullish trade. Not only the overall index, but if you look at the UK, you look at the DAX, you look at the Switzerland, you look at the France, Italy, Spain, Germany. DAX is Germany. Bullish trend, bullish trade. We are at the top end. It's not the place to be long of them, but no signs of danger. No signs of danger in Europe, in European equities right now. One thing to point out, this similar setup once again, Kospi and South Korea and Taiwan. Heavily tech oriented countries, and all of them is signaling bullish trend and bullish trade right now. So that's why the tech is performing exceptionally well in the US and across the curve, across the world. Tech and tech sensitive things perform exceptionally well right now. And if you want to ride the momentum, this is the place you want to ride the momentum with. So Kospi, bullish trend, bullish trade. We expect Kospi to reach the previous cycle high. EWY, we expect to reach the previous cycle high as well. So positive on Kospi, positive on TWD. Let me TWI, yes. Positive on that. Well, this chart is essentially the chart of the TSM, the biggest company. And this guy is also pointing to the bullish trend, bullish trade. And this move, essentially this summarizes the move in the whole tech complex very well. A normal retracement on a trending basis and the continuation move to the upside. I would not be surprised. And we've broken into the through the trend, so it's bullish trend, bullish trade, top end. But you want to be long of these things if you want to ride the momentum. I would expect a continuation. I would not be expect a reversal right here. We're expecting continuation here. Even though we've listened to TSM guidance, even though we listened to AMD guidance, even though we listen to Qualcomm and to the whole complex of semiconductors, the outlook are not particularly shiny. But this is the reality. Market moves as it moves. So this is what's happening right now. Yes. How did we end up with TSM? Yeah. Taiwan and Kospi signaling bullish trend, bullish trade. These are the places you might consider being long of. India is a very interesting thing. The currency is being impacted by the rise, by the repricing of rates higher. So the Indian rupee is falling against the dollar. Indian markets is rising, bullish trend, bullish trade, and generally it performs very well when we have repricing of CNH lower, and this is essentially what we are getting here. Repricing of CNH lower. This is an inverted chart, so rise in the orange line means the fall in the CNH against the dollar. Devaluation of the CNH. You have the nice move in the Nifty. Retracement on the Nifty. Move higher on the Nifty as well. So that's a simple setup right here. And we think it still has some legs. It still has room to go. We are seriously considering being long of this guy through the. There are not many options to, but we are considering to be long of the EPI, Wisdom Tree India earnings. We'd like to get long of the EPI. Actually, we will probably get a long position this week. We shall see. This is one thing to point out. Europe, Mexico are not particularly fond of Mexican peso, not particularly fond of repricing of rates higher and the dollar higher, which is getting a normal retracement within the bullish trend. I'd expect it to reach 58. If it reaches 58, we are biased at 58 right now. Most likely, we're going to buy that at 58. Bullish trend, bullish trade, secular and cyclical realities are very favorable for the Mexico. So this is the thing. Poland, the most bullish thing in Europe right now is Poland. The smallest debt GDP ratio out of the whole Europe, with Czech Republic as well, the smallest debt to GDP ratio. So the Poland will be all right. The Poland will not have to do the financial repression. And the Poland right now is outperforming the US and the Europe as well. Do you want to be long EPOL? It's not the time to be long EPOL, definitely. It's just momentum game. I would not be long of Poland at this time. So, but this is a bullish trend. So if anybody is calling for the major global recession, not going to happen this week. It's not going to happen. Not going to happen this week. We are operating on a week by week basis, so we are preparing for the upcoming week. Everything in the equity space abroad, across the curve, across the border, points to the upside. Everything is all right. Everything is fine. Let's now go through the emerging markets. Nothingness in there. These are European equities and Chinese equities. We've been calling for this similar setup and repricing of Chinese equities lower. Let me put on once again the CNH and let me put on the HG. Oh, I'm sorry. So the correlations right here are very tight in between those three instruments. Industrial demand falling, horrible numbers from China on a relative basis. Therefore, the reopening not leading to the same effect that people would have expected. Falling copper futures, falling copper prices, rising, devaluing the yuan, and we think on a secular basis, the yuan has to devalue significantly, very significantly. And this might be just a cyclical confirmation of this. HSI hasn't gone down to the reprice lower to the same extent that the copper prices repriced lower and the CNH repriced lower, but it's still pointing to the bearish side. It's bearish trend, bearish trade, and we might get an expansion. We might not, but generally equities are just seem to be indifferent. In the US, equities seem to be indifferent to everything that's going on with the macro space. And in China, same thing's going in China, but don't be long of Chinese equities. God forbid, no. If you want to contemplate shorting it, yes, you can do that. Do they think it's the best short that you can find out there? No, but it's a decent one. So that's our take. That's our take on China. And if you look under the hood of these indices, the biggest names in the HSI and the FXI are Alibaba, TME, Baidu, and JD. They account for 20% of the index, if I'm not mistaken. And Baba is pointing to the downside. Horrible chart. I mean, just completely horrible chart. Bearish trend, bearish trade. Just simply can't find a support. And if it breaks this level, we might see a continuation lower in the Baba and therefore in the whole equity space in China. Bearish trend, bearish trade. JD, same thing. Bearish trade. And Baidu, bearish trend, bearish trade. But the TME, the only thing across all of the names that we are currently observing in China, the only thing that's pointing to the upside is TME. It's the relative outperformer. Bullish trades and bullish trend at this point. It just has to break 720 in order to change the direction. But this is the reality. Not the place to be long of, definitely. Yes, that's it. That's as to the overall world equity space. Let's go through the SPY, QQQ, IWM, the diamonds. SPY. Just based on the consolidated equity signal. Bullish trend, bullish trade. We do expect SPY to reprice higher. Let's look at the SPX. SPX. This is the trade support and this is the trend support. We do expect SPX to finally break through this region and reprice higher, reprice back to the tail resistance at 4,300. This don't seem like a stretch to us. This repricing of equities to 4,300 is a possible reality. Bullish trend, bullish trade, definitely. In regards to the risk, to the relative risk and risk ranges, and to risk to reward ratio, this is your trade. If we get a move downward from here, non-cyclical, non-trending spike in volatility, holy smokes, we are buyers of that. So we still cautiously long of equity. We have some puts on the names that we like, definitely. We do expect another repricing of equity higher right here. Now, in what form it will come, we don't know, but this is the trend, this is the trade. If we get a move lower, we are biased on that. Consolidation is also fine for us. So we are neutrally positive on the SPX right now. So okay, we are long and we are positive on the tech sector, and we think, despite the major counter arguments by most of the people, we think this move in QQQ and in let's open up QQQ still has room to go. Still has room to go up to 350, somewhere in that region 350. The Nvidia earnings on this week will be indicative. Apple, Microsoft, and if you look at all of the big names, all of them are very, yes, I acknowledge they are very overextended on a trending basis. And on a trending basis, if you're an investor and you're looking at 3 months ahead, I don't think we're going to be in 3 months. I don't think we're going to be much higher on Apple from here, and I don't think we're going to be much higher on Microsoft or Google or QQQ. We might find ourselves simply in consolidation on a trending basis. We might get another repricing higher, but this is not going to lead anywhere. But generally, Apple, Microsoft, all of them are signaling bullish trend, bullish trade. Tesla signaling bullish trend, bullish trade. Meta signaling bullish trend. And Netflix, BRKA, Visa, MasterCard, all of the names, all of the biggest names in equity space are signaling bullish trend, bullish trade. And we are expecting creation of a higher low right here. Higher low and continuation higher. Higher low and continuation higher. Even the most sensitive and most vulnerable things throughout the equity sectors, equity complex signaling bullish trend, bullish trade. IWM, well, we are in a period of obviously, as you can see, consolidation. We would not expect a major repricing out of this consolidation. All we had is taken out of the low of this consolidation, and another move higher into 170 and 180 for the IWM will not be a stretch. So the flows are positive in IWM, the flows are positive in SPX, but we are somewhere, in comparison, you can look at this period, say we are something similar to this period. We find ourselves in this same environment, same here, right here, but with more realized volatility. That's it. Flows are positive for IWM. We expect IWM to reprice higher into 180. IWC, same thing with IWC. Flows are positive. It's negative trend and negative tail, definitely. We would not expect it to reprice meaningfully higher. That's why we're neutrally, cautiously long of it. Bearish trend, bearish trade for IWM and IWC. Negative trend on both of those, but bullish trend on SPY. DIA, diamonds, DIA. Bullish trend, bullish trade, same thing. Consolidation, upward sloping consolidation. Industrials is not the place to be in right now. Tech is a place to be in right now. Maybe consumer staples is the place to be in right now, but the industrials is not a place to be in, just completely irrelevant, I think. But we look at this anyway, just to get the probabilities right. That's it. If you look at the growth versus value, this is the value ETF, this is the growth. Obvious outperformance. It looks like we are simply in the reflation environment. And yes, it looks absolutely absurd at this point of time. We are definitely in a slowdown and we're probably going into contraction. How severe it will be, God knows, but we are definitely in slowdown. And to see this move, this type of the move, this magnitude of a move higher in the reflation type of move is very strange, but this is the reality. And our point being that it still has lags. Nothing is pointing to the opposite direction right now in equity space. So that's it. We might get the non-trending spikes in volatility associated with the endogenous events like the debt ceiling, but I don't think it's going to lead anywhere to anywhere. We're not going to get the same response from the equity prices as we got in 2011. Oh man, it's very dangerous words. Well, we have our money on the line, so we are very cautious about it. QQQ, we've gone through QQQ. The sectors that are in favor with us is obviously XLK, XLY, and that's it. To be honest, that's it. You see, the breadth is horrible, is absolutely atrocious in the equity space. So this allows us to put the trades like this, to put long TAC, to put long SPY, to put trades long get SPY, and at the same time short XRT. We've highlighted this relationship right here. Let me scroll upward to find what was the date that we pointed this out. Boom, boom. You have to bear with me. Unfortunately, why am I so dumb? Just type in XRT. That's it. Here's the chart of the XRT retail sector with SPY overlay. We can see the clear divergence in the last leg up, and if we are correct in our contention that we are inching towards the recession, retail should be the weakest link, and this is the reality of it. Look at this divergence, and this divergence has legs. We are going lower with retail. Is the most sensitive and the weakest link, and across all sectors, we like to short retail the most right now. Short retail. You can just sell calls on XRT on, or just put on short trades in whatever fashion you like, and be long of SPX, and this is your pair trade. And look at the XRT ratio to the give me that to the SPY. Oh my goodness! XRT divided by SPY. This is your outperformance, SPY outperformance. Look at that. If you would have bet on that ratio, you're making money. They're definitely making money. We've been calling for this trade, and this is what's happening essentially. I favor short across all of the sectors in XRT. Relative long is XLY, even though we are in a cyclical slowdown, definitely. And XLY is supposed to be the most a sensitive thing, as well as the XRT. XRT is confirming that reality, and XLY not, because it has Amazon in it. But it is what it is. But we don't expect a major cyclical move higher based on the expansion in the business cycle. No, this is simply trading, immediate reality. We might see that. That's why we're not calling for a major move higher. We're just calling for consolidation, maybe another leg higher, but the positive flows, essentially positive flows in XLY. The things that are looking to short is XOP, OIH, XLE. The whole energy sector. XLF as well. We are neutral to short of XLF. Negative flows definitely. XLRE, negative flows definitely. I completely forgot. ITB and XHB. Bullish on those. Good places to be in right now. Whether they continue to outperform as they did, I'm not sure. But these are good relative places if you want to be long of. I don't think it has much more room to go to the upside without a good retracement. I don't think so. But as long as SPY stays in consolidation relatively has a positive flow to it, ITB will do just fine. XLC as well. The XLP and healthcare, two defensive sectors that are supposed to work in these cyclical slowdown that we find ourselves in. On an immediate basis, they're signaling bearish trend. So this is not the place to be in. We are definitely in reflation. In the environment where growth goes up, value stays stagnant, and XLP, once again, one more thing that confirms it. We're not bearish in XLP. No, God forbid. We're looking for consolidation. After this major repricing in XLP high, if you look at Pepsi, if you look at Coca-Cola, if you look at Procter & Gamble, if you look at the Mondelez, if you look at the... What else is in there? Hershey, Walmart, we had our major repricing based on the good earnings, nominal earnings, inflation boosted earnings, inflation inflated earnings came out amazing. The numbers from this sector is coming out amazing. So we have this repricing higher on the basis of those earnings. But slowly, this sector is experiencing, as it should, within the environment we find ourselves in, with this reflationary boom that is happening. We are just neutral, consolidating. Maybe another move lower, maybe another move. Nothing to see here. You can sell puts on it if you like. You can. We are neutral. Let's say we're neutral to negative right now on XLP. So we do not expect another major repricing higher. And this ties in very nicely with the trade that we're going to discuss, the Costco trade that we're going to discuss at the end of this section. So, and the XLV, another thing that's supposed to perform, let's open up pink, relatively better performance, supposed to perform in this environment, not doing so, just simply not doing so. It's not the quad 4 environment that we usually find ourselves in, so not place to be in at this point. As to the, and everything that I said right now is connected to the upcoming week. Everything might change. At the end of this week, the next week update for the next week, I might come out and say that holy shit, everything has reversed and we have to go short. But we will have to do that. But right now, everything's pointing to the upside, and we are positioned to the upside. And if it reverses, we will notify you within the week, and we will we'll get on the right side of the market. Okay, we've gone through this, we've gone through that, and the only thing that's left for us is we've gone through the major names right here, and we are long of everything right here. Everything is pointing out to the neutral to positive flow, so everything is fine. Visa, we are short. We are short a put on Visa, 225 short put. If it stays in consolidation, we're totally fine with it. We expect a slow repricing of Visa and MasterCard, continuous repricing of these names higher. Maybe due to this more reflationary spike, reflationary sentiment in the equity space, we might get an actual retracement of these so-called safe haven assets, safe haven equities like Visa and MasterCard. Maybe we get a retracement and consolidation that we might get, as well as we are seeing the same thing happening in the staples space. So everything that's defensive is not in the favor of this market at this point. So, but we are still short volatility. We're still selling vol on these names. We are selling puts on these names. We want to be long on them, and we are utilizing them as an income factory essentially. Interesting thing we're looking at, the interesting trades we are looking at is the Morgan Stanley short. This is one of the strongest shorts from big names in financial sector. It would be very interesting to pair up JP Morgan long with MS, with Morgan Stanley short. Fuck off, I'm telling you. MS divided by JPM. Yes, and you see this relative outperformance of the JP Morgan. I would like to put money on that relative outperformance, to be honest. Now, whether shorting Morgan Stanley directly or going... I'm not so keen on going long JP Morgan, to be honest, but I like to short Morgan Stanley. And we think we're going to do that. We think in order to reduce our beta-weighted dollars, we will... short, add it to our XRT short, and maybe put on a Morgan Stanley short in order to reduce to get more neutral in the market. We like that. We like this short, like very much so. Another repricing of Morgan Stanley down to $77 is within the probable boundaries. The whole semi space, bullish trend, bullish trade, incredible expansion. It's not the place to be long of them, obviously, only if you want to try to play a momentum game. But we are looking to play NVIDIA. Earnings, very interesting. Let's see how it behaves throughout the week. We shall see if we want to play them. They expect to beat the expectations, and just looking at the sentiment, looking at the overall equity markets, and looking at the overall sector, I think NVIDIA... Well, even though it seems really absurd, even though on a fundamental basis it's as undervalued, as overvalued as it can possibly be, but it can go higher. It can go much higher from these prices. And I think if they beat the expectation and give good guidance, they can just talk bullshit, to be honest. They just can talk fairy tales that they're going to make hundreds of billions of dollars and they see a very incredible future connected to the AI side of their business. Yes, we might see Nvidia back at all-time highs. It just very much depends on the behavior before the earnings. In earnings, we're going to get on Wednesday before the close. Yes, before the close. And please God, if we're going to get a move downward in the Nvidia before that, if we open up very negatively, if we open up and we are going to go below $300 on Nvidia, just as we did in MSFT with Microsoft. Look at what happened before the earnings. Break of trade, obviously creation of a higher low on trend right here. We've been long of Microsoft right here, just better price, another impulse higher. Just same thing happened with Apple. We wanted to get long of Apple. Into the earnings, you have this massive drop into the, not massive, just relative drop into the earnings, into the key zone right here. Get long of it. And how we played those two names. Simple diagonal spread. We shorted the closest expiration with the that contain the earnings with the volatility on that expiration is around what was it on Apple, 50% higher than the longer dated expiration. So essentially the vol surface looked like that. We shorted this volatility, we bought this volatility, and we did pretty well. We very like to put those trades if we are directional, and we want to be directional on any given name that we are acquainted with into the earnings. This is the way we really like to play it with the diagonal spreads. And once again, Nvidia. If Nvidia does that, if Nvidia gives us a good entry point right here, but at the same time, if it's gonna keep climbing higher into the Wednesday, and on Wednesday, I'm not gonna be long at that. Definitely not gonna be long at that. But if it drops lower, my goodness, please give me that. Please give me that. We're gonna buy long dated volatility, maybe June or July, probably July, 60 days out. We're gonna buy 60 days out, and we're gonna short maybe 340s, 335, and I think it's gonna work. I hope it's gonna work out pretty well, but we shall see. And that's it. Oh, and AVGO as well, yeah? No, it's 1st of June. Another name we'll be calling now as a long in great setup. We've observed this setup for quite a while, and finally we get an expansion. Good place. We think this move still has lags. ISML. Yes, just be long of that space. As of now, be long. Cautiously long of equities, and this is the best place to be long of it, obviously. We explained how we're gonna play Nvidia if that happens, and the other earnings that we have coming in right now are on this week, if I'm not mistaken. Yes, Nvidia on Wednesday and Snowflake into the close as well. Lows. Let's leave the lows for a second. And Snowflake, concentrate on Snowflake. We've been trading and observing this name for a long time, and we think it's gonna beat the expectations, and we think it's gonna outperform. But right here, we would like to play, once again, depends on how it's gonna behave coming into the earnings, coming into the Wednesday, and on that day, on Wednesday, we're gonna put either short straddle or a diagonal spread. We're gonna see on Wednesday. We don't know right now, but we are leaning long Snow, and we are leaning along Nvidia. Even though every single fiber of my being is saying, my God, they're so overvalued. The fucking Snow, this guy just doesn't even make money. The more money they make, the more money they lose, because the net margin is minus 20%, if I'm not mistaken, just 25%. But it's all about flows. It's all about the flows. And if I'm not mistaken, Snow trades at 270 P. I mean, they don't have earnings, so they don't trade. They don't have PE. It's all about the flows. some of the flows and the ability to recognize the flows. And going into the week, once again, we neutral to bullish. If you play earnings with the short volatility, you have to get an idea of, once again, what's the macro space is doing, what the beta is doing, because Nvidia in Snow has 1.7 beta to the market, so you have to account for the beta risk. We account for that by doing the cross asset class analysis and understanding the dynamics. If we are setting up for something bad to happen this week, or maybe not. If not, if we are neutral to positive, this is perfect. We, as well as we can, we reduce our beta risk in our mind. And mitigating beta risk is very important in order not to get something like this, in order not to get a move in the stock based on the overall macro component, based on the beta. You have to mitigate that risk, so beta. You have to mitigate as far as best as you can the endogenous risk. Endogenous means the risk, not the endogenous, what's the name? I keep forgetting those technical terms. I mean, the risk associated with the company itself, obviously, you have to do that. You have to have your expectation coming into the earnings. You have to understand the flows, and you have to understand the relation to the competitors, how they reported earnings, and to the overall sector itself. If you can mitigate those 3-4, understand, get a good idea of those 4 factors, you stand a good chance of making money on short volatility. You can tweak your short volatility trades like diagonals or straddles or ratio spreads. Essentially, we like to play with straddles. You can skew straddles to your liking. But looking at Snow, flows are amazing. Based on our signal is just good. It's ripe to another expansion higher. Beta, we've gone through beta. Beta is neutral to positive, is okay. If nothing is going to happen with beta, we are perfectly fine with that. And the sector, overall, tech sector, absolutely ripping higher. So if, let me show you with one example what I mean by beta and sector risk. Let's look at the Deere. Deere reported amazing earnings. The earnings were good. The earnings were great, actually. The numbers came out all right, and the guidance was all right. But it's all about the flows. It's all about the perception of the market, of the overall sector. And if the flows are not there, if the flows are negative, you get what you get. Good earnings, you get a nice spike higher on those numbers. But the flows are not there. The interests of the market are not there. So essentially nothing happened. Nothing happened with that name. We closed almost what we opened. This is the reality. Same thing with Walmart, WMT. In this WMT, there's staples, XRT. We go through XRT. We are calling for this reflationary type of the move. So the defensive names are out of favor at this point. Even though the numbers are great, the Walmart reported amazing numbers, and we had this move higher. Look at that. We have this move. We close our position right here. But overall sector is falling out of favor, slightly falling out of favor. So there were no continuation to this move, just because the flows are not there, because the flows are neutral to negative. We've gone through that. If you understand that, you might understand how it's going to play out throughout the day. But at the same time, if Snow reports earnings, if numbers are just pale, just okay, if Nvidia does that, if numbers are okay, just pale nothingness, absolutely nothingness, in line with expectations to the pip, in line to the cent, and the guidance is okay, fine, nothing amazing, nothing extraordinary, no promises, just fine. We expect fine, we're gonna be okay throughout the year. Then the stock is gonna just rip higher, just based on the flows, just based on the sector reality right now, just based on what is going on with the liquidity dynamics and the flows throughout that sector. So if the Snow reports horrible earnings, if Nvidia reports horrible earnings, what are we gonna get? We might get a meaningful move lower, and maybe will happen with Walmart, maybe will happen with Deere, which is just gonna close back up, just because with the flows out there. So based on the flows, based on the sector dynamics, based on the sector risk, based on the competitors, based on what earnings came out already in the tech sector, the risks of these names, if you want to play the Nvidia or Snow, is to the upside, and beta is neutral. So that's all right. That's the reality. That's how we think of playing these names. And the polar opposite is Costco. Cost. Also very interesting name. Very interesting name. It's the second largest retailer in the America. Walmart, direct competitor with Walmart. These guys have been moving essentially in the lockstep with each other. They usually start moving. Yes. This is what we have. Just perfect correlation, upwards of 70%, 75, 80% correlation. And same thing, the correlation, the beta of Costco and Walmart is 0.75. And if I put on SPY on that, you see how it moves relative to the SPY. And you see this underperformance. SPY is moving higher based on the tech numbers moving higher, and the defensive names are falling out of the sector. And our contention is that this will continue, this will persist at least throughout this week. We have to get this week right, and this is the reality. So if they report, and just based on what the Walmart reported, just based on all what the other guys reported, because all of the sector has already reported, and the Costco is almost the last one out of big names. The earnings should be good. The earnings, just as with Walmart, should not. Well, they should not disappoint extraordinarily to the downside. The earnings should be all right, but at the same time, it's not enough. Not enough to just to break this sector correlation. Not enough to break this reality of unfavorable flows, meaning no flows into this sector at this point. So we do expect the risk with this name, based on sector, is to the downside. Based on earnings, is to the upside. So we do expect, with Costco, we don't have a bullish bias or a probably bearish bias. You look at the beta, neutral to positive. This negates the sector, bearish to neutral to negative. Earnings are neutral to positive. So not on those four factors, we don't get a clear one-sided idea of where the stock should go theoretically. So we're just gonna do probably a standard 16 delta, 1 standard deviation strangle on this name. Once again, the decisive factor in every single one of those trades is what the thing is doing relative to its trend signal and trade signal. We are always going to put the signal above everything else. And right now, the signal is as neutral as it can possibly be. So nothing here points to any of the direction. Let's see how we're going to behave coming into the Thursday. If we are going lower and we retesting trend, we are going to put the skewed strangle to the upside. If we are going higher and retesting trend, we're going to put skewed strangle to the downside. So this is what we're looking for. These three names that we outline, and that's it. Generally, that's it. On the short side, even our shorts are longs right now, because just meaning during this week, because there are a lot of things that are signaling bearish trend. But overall, like HDO, like Pull, like LESL, there are good shorts to have, but you have to be very careful with balancing the long-short book. You have to be very careful. Okay, I've talked too much this time. Next time we're gonna concentrate on shorts a little bit more, but I think it's less relevant coming into this week. You gotta have a balanced portfolio. You gotta have shorts on your book, definitely. And on the bigger scale, on the scale of sectors, we pointed out what shorts we like. We like XLRE, we like XRT the most, XLU. Yeah, that's that you decide. You decide then. Okay, all right. I think this was the comprehensive breakdown. Just to sum up, neutral to positive, neutral to negative on Bitcoin, on crypto space, on immediate future, and on trending future, it's positive. Be long of crypto. Neutral and completely neutral on rates coming into this week. We're not going to get a major repricing higher or major repricing lower. Methinks this is not how methinks. This is how we set up essentially on the whole rate sector, and neutral to positive on equities. Just to sum this up, I have to point one thing out. This is not the time to be a hero, definitely. This is not the time to be very, very directional. The time will come when you will have to be very directional. I'm pretty sure of that. Whether we get an exogenous or endogenous event, recession, or an external event, some type of war or whatever, and we get these markets moving once again, yes, there will be a major moves, major trades to put on. Right now, it's not the environment, and debt ceiling is not the thing that's going to shift us anywhere meaningfully, and that's it. There's nothing else on the horizon. And within this cycle of this rate hiking cycle, we are at the peak, close to the peak definitely, and we are in the moment of peak uncertainty. So this is essentially reflected in the rate sensitivity sector, and this is how we position. That's why we don't think that the dollar is gonna break out higher. We just taken out this low, and this is the tail support for the dollar, and we're just gonna march on higher from here. No, neutral, completely neutral. We are in this consolidation on the dollar, just as well as we're consolidation in the gold, in XLU, in credit, in fiat alternatives. Holy moly! Yes, so you have to play it accordingly. That's the idea. Okay, I think that's it. Thank you.